One of the major things that I took away from the Federal Reserve meeting was the cut in QT. To me, him and Bessent are probably having their tuna fish sandwiches every week together. And I think they're in cahoots here in keeping a lid on the 10-year yield. And that is why Jay Powell did what he did, even though he made up some story that there was issues with money markets. But there are no issues with money markets. That really took me by surprise, but tells me that there's something else going on here.
Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, also a CNBC contributor and author of the book report. That's Boock. It is so great to see you again. Great to welcome you back on the show. Thank you so much for taking the time to join me once more, Peter.
I appreciate the invite, Julie. Always fun.
Anytime. And the last time I saw you, it was the December FOMC. So it's been a while, even since our last conversation. So thrilled to get you back on. For folks watching and listening, we are recording on Thursday, March 20th, the day after the March FOMC, where the Fed held rates steady. So since it's been a while since we had you on, Peter, can we kind of start big picture, macro view, where we always start? And as you know, you can take the time, all the time you need to set the table when it comes to that big picture, where we are in the economy and the markets.
I think there's some big picture changes that are taking place that I think investors are slowly beginning to acknowledge, but not necessarily appreciating the extent of it. You know, when we look at sort of the post-COVID world, where we had obviously the sharp rise in inflation and interest rates, but starting in late 2022, early 2023, sort of post that dramatic rise in interest rates, what lifted the stock market off its October 2022 lows was the AI tech trade that became extraordinary and took these big names to market caps that we never imagined was possible, particularly relative to the size of the US economy and the global economy. And for all the thoughts that the US economy would fall into recession because of that aggressive rate hiking cycle, and I was one of them, an enormous amount of government fiscal spending kept that from happening. So now I believe we are sort of reversing some of those mega trends to the point where I think the investing and economic playbook that has worked so well over the last couple of years should literally be thrown in the garbage. I think that is actually really beginning last July, when investors started to digest second quarter tech earnings, when people started to ask questions about the sustainability or really the return on all this AI spend, and that you're spending $15 to $20 billion a quarter, they being Meta and Microsoft and Google, Amazon, and when are you going to show me the money? But, you know, the trades still continue through the rest of last year, particularly on the supplier side, like NVIDIA and Dell, those that were beneficiaries of all that spend. But then, of course, what came out of nowhere in January was the DeepSeek news, where coming into work that Monday, while there was chatter the previous Thursday, Friday, I think it took most of us completely by surprise, with many asking, who the hell is DeepSeek and what does that mean? But I think that was a sort of a seminal event in the markets. And I think that sort of ended that AI tech trade in terms of these 7 stocks having the ability to carry the markets on its shoulders, to the point where the 7 stocks, the Mag 7, were 35% of the S&P. The top 10 were almost 40% of the S&P, which far surpassed the concentration that we saw in March 2000. So we've seen a reversal in that Mag 7 trade, obviously mostly with Tesla down about 50% from its highs, but the others were down, call it 15 to 20% off its peak. And I think that trade's over, not in terms of the quality of these companies. They're still going to grow, most of them, but in terms of their outperformance. And I think we're in a period of potentially multiple compression with these names, particularly Apple, which to me was the most grossly overvalued, as well as Tesla, of these stocks. So if you're going to lose 35% of the S&P, you know, what does that mean? Where are investors going to go? And I think also to tie this into even big picture thinking as well, is the Mag 7 was not just a loved group of stocks for US investors, it was a loved group of stocks for global investors. It became, in a sense, a reserve currency to the point where central banks overseas owned these Mag 7 stocks. And I've talked in some of my writings and in other interviews about the Norges Bank and highlighting NVIDIA. The Norges Bank, as of December 31st, so it is somewhat dated, but that's the last 13F filing that we got from them. They owned 324 million shares of NVIDIA. They were the 10th largest shareholder of NVIDIA. The Swiss National Bank, with money printed out of thin air, at least the Norwegian central bank, they have sovereign wealth fund and they have, oil and gas revenue that comes in. But the Swiss National Bank, they just print money out of thin air and they use it to buy stocks. They owned 90 million shares of NVIDIA. They also owned Tesla and Microsoft and Apple and Amazon and Alphabet and all the others, as the Norges Bank did as well. So it got to the point where at the peak, foreigners owned about $17 trillion of US stocks. So what we've seen, you can actually draw a chart over the past year of the rally in the Mag 7 stocks last year and the rally in the US dollar and the sell-off in the Mag 7 stocks and the sell-off in the US dollar. That's how I think pronounced these foreign flows into these stocks became. So if you lose the AI tech trade, well, that obviously creates vulnerabilities for the S&P 500, but it also creates issues potentially with the US dollar. Then, of course, we have the major support for the US economy over the past couple of years, and that was government spending to the point where the US budget deficit relative to GDP got to around almost 7%. That is usually what is seen at the depths of a recession. So if Scott Bessent gets what he wants, and that's a 3% ratio of the budget deficit relative to GDP, that long-term is a really good thing. And it's something that we should be striving for. But in the short term, that has major negative implications for not just economic activity, but for corporate profits as well. Because for every dollar that's spent by the government ends up as a top-line revenue sale in the private sector, whether it's a government office building that is being paid to some private landlord, or it's the cafeteria where that dollar is being spent to some outsourced company like Compass or Aramark, or it is travel. I think it was Southwest that talked about reduced government travel as one of the negative impacts on their recent revenue growth. Mm-hmm. And so these are major
or like software seat licenses.
Exactly, to Microsoft, ServiceNow, Workday, all these companies that have benefited from this. So these are major sort of tectonic type shifts that I think are taking place that drove top line revenue growth, that drove the economy, that drove multiple expansion. And I talked about the AI tech trade. So the question is, from an investor standpoint, is can the market sort of pivot into other things, keeping things afloat? Certainly, international markets have been a huge beneficiary of the shift, with the German DAX up 17% year to date. As we do this, the Hang Seng up about 20% after a high teens return last year. In fact, the Hang Seng has outperformed the S&P since December 31st, 2023. Going into last year, it was one of my top picks, thinking that it was going to outperform the S&P last year. It did not, but obviously over this 1 year and a quarter time frame, it has. So the market's now fishing out cheap stuff around the world that have been left for dead for years. And I think this is a multi-year trend, not just a few quarters. And even with the US, the Russell 2000 can't get out of its own way because there's worries about growth. But from a valuation perspective, there's so many cheap stocks that I think investors can now locate. And even the other 493 within the S&P, there's value to be had. So I think this is something that we should pay attention to. And then, of course, you throw in the tariffs that create its own muddied situation with respect to both growth and visibility. And just to tie in the one last thing, if the Mag 7 ends up dragging the market down overall, which is what we've seen over the past month with the 10% correction, generally speaking, for the markets, if this becomes more pronounced, well, then that is going to potentially negatively impact upper income spending. Because when you look at the economy, I talked about the government being such a huge boost to spending and government being such a huge boost to economic activity. But the AI tech spend has been a huge boost as well, because CapEx X AI has been rather muted. And the third leg of the stool, and there's not four legs, there's only three on this stool, has been upper income spending. So there are really important things that we have to pay attention to. And, to that last point, if the stock market, the 10% fall becomes a 20% fall for whatever reason, well, then, chicken and egg, you actually start to negatively impact the economy from that. So some major things here going on. At the same time, you have the administration with market-related people there, like Scott Bessent, who I think understands a bunch of these dynamics. Now, he said he's more focused on the 10-year than the stock market, but you have to be careful of not paying attention to the stock market because of how that will affect the economy. But I think one of the major things that I took away from the Federal Reserve meeting was, the day before we were taping this, was the cut in QT on the Treasury side from 25 billion a month to 5. And Powell sort of laid it off as, oh, this is just a technical thing, and we're just going to further extend out QT. But to me, him and Bessent are probably having their tuna fish sandwiches every week together, and their Diet Cokes and a glass of water. And I think they're in cahoots here in keeping a lid on the 10-year yield. And that is why Jay Powell did what he did, even though he made up some story that there was issues with money markets. But there are no issues with money markets. That really took me by surprise, but tells me that there's something else going on here.
Yeah. Wow. Peter, I got to say, awesome frame up to the conversation, because there's so many threads I would love to pull on with you. And I really like that three legs of the stool, that government spending, the upper income spending, which I take it that 10%, like Scott Bessent pointed out, the 10%, the top 10% of Americans that make up half of consumption. And then when you tie that back to the AI tech spend, those are the asset holders that have been benefiting from these markets as well. Such a fascinating way to look at the economy. Couple of things I'd love to just explore a bit more here. You're saying throw out the old investing playbook, put it in the garbage. That doesn't work anymore. This is not like a short-term thing. So I take it when you look at like the markets more recently in the last couple of days, coming back from that route that we saw in the last month, don't get too hopeful.
Well, we were going to get a bounce. We're getting that bounce, and the drop in long rates will probably help in that bounce as well. This is sort of a, threading a needle on how all this stuff plays out. I think one of the issues with the S&P, and I'll talk about, the S&P because it's different than other parts of the US market just because of the influence of those names and how expensive that index got, to the point where at the peak in the S&P, we were trading at 22 times forward earnings. And to compare that to March 2000, which was an epic bubble and peak, we were trading not too far above at 24 and a half times earnings. So there was no valuation support for a lot of the big picture things that I'm talking about here. And that's also one of the issues with the stock market, is no margin of safety here from a valuation perspective.
What if you can grow your gold so you're not just preserving, but you're growing your wealth in an asset that can't be inflated away by money printing? Monetary Metals lets you do just that. You can earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even as high as 19%. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. I saw a great tweet you put out yesterday after the FOMC about the Fed, and I just wanted to get folks to pay attention to this because you said while we still obsess over every Fed word and projection, there's a big picture important point to make, I believe. When inflation was consistently between 1% and 2% pre-COVID, or at least in the multi-decade declining path, the Fed had all the license to respond with monetary policy, especially in experimental ways, to whatever economic ills came our way. The big difference now, I believe, is that in this post-COVID inflation growth spurt, and now with the huge cloudiness, with the impact of tariffs, the Fed is just not there for us in the same way we became long time accustomed to. So it kind of sounds like we're in a totally new paradigm, but maybe folks haven't quite caught up yet.
Yeah. So in another way of saying what I said, as you mentioned, is the Fed potentially is much less relevant here. Granted, they definitely were influential yesterday and today in getting the 10-year bond yield lower on the QT news that I mentioned. As Scott Bessent wants. But I think overall, we're in a different inflationary environment. While we're well off the mid 2022 highs, and some people were going to go into a deflationary trend, and that us inflationistas are out of our minds still. I think that going back to 1% to 2% inflation on a sustainable basis is in the past, and at least over the next couple of years, 3% to 4% is the new inflationary normal, and we're gonna see two prints in the back half of this year as the rental component starts to reflect the low pace of rental growth increases. But with tariffs and flowing through, and we're already seeing a bottoming of goods prices, I think the Fed's just going to have much less ability to confront economic challenges. And yeah, maybe they'll cut a few more times this year, but the days of going back to zero and ramping up the balance sheet and being able to do whatever they wanted in response to an economic recession and downturn, I just don't think they're going to have that same capability. So you lose that. And I'm not saying that there's no Fed put anymore. They'll at least try to stem any major problems as they always seem to do. I just think that it's going to be much less effective, and there are going to be a lot more unintended consequences. So let's just say the Fed got more aggressive in cutting short-term interest rates. Well, what have we seen since they started? They've already cut 100 basis points. We've seen the long end, even with this recent decline, still stay very elevated. So if they got too aggressive and the bond market didn't like it because they were worried about inflation, then long rates would probably go up. I mean, look at, you look, okay, so we see this drop in long rates, but copper prices this week are hitting an all-time record high. I mean, this is the most important industrial metal in the world, whether it's through used in construction, an iPhone, the computer that we're doing this call on, whether it's being used in EVs and trying to power this whole renewable world that many want us to have. Copper is so important, and it's hitting record highs. So I think there are a lot of reasons for inflation volatility, as I said, and we'll see some deflationary signals in some parts, but there is an inflationary impulse that I think still remains, that it's going to really hand tie the Fed and other central banks.
Okay, so inflation's still a pervasive issue. You brought up copper prices. Oftentimes, like, at least from what I understand, folks look at copper prices as maybe a bit of like an indicator of like the direction of the economy or the state of the economy. Is that still the case? And if copper prices are all-time high, I guess that's a good sign for the economy. I don't know. Is that because sometimes I feel like people look at it as a recessionary indicator too, like when the prices are falling, right? Or did I get that totally wrong?
Yeah, no, you're absolutely right. And that's why they nicknamed it Dr. Copper, with, a PhD in economics. That definitely is a factor. But, we're also seeing $3,000 gold.
That too, yeah. It's a little perplexing, yeah.
Yeah, so part of the move in copper is similar to the move in gold in that the geographies of the holdings are shifting because people are worried about tariffing our international trading partners. There's a lot of reshoring going on with gold from London vaults to New York vaults. There's been a big push in bringing copper into the U.S. for domestic users on worries that it's going to be tariffed as part of of all these tariffs. So that is also part of this. So it in a way, it's unfortunately not because growth is stronger, but it's the shifting needs of where these important commodities are having to be, and also highlighting the importance of the need to get your hands on this stuff. We're at the point where the U.S. government is trying to do deals with Congo, because we need to tap into their raw materials. Trump's saying he wants to take Greenland, which is not going to happen. But just by saying it, well, it's okay. They have a lot of rare earths that we need, and so there is this global thinking about, I can't get shut out of my access to these important commodities. So we're long them. So we're I'm talking my book here in terms of highlighting the importance of these things, but it's happening nonetheless.
Yeah. Okay. That's fascinating too. Okay. So commodities are something you have been long or you're looking at. Okay. So kind of in this new world, if you will, it sounds like, again, like you said earlier at the top, throw the old playbook out. Where do you want to be? What are the opportunities? It sounds like opportunities even outside the United States as well. Not the big tech stocks, of course. What can you share about where you might want to be allocated and why?
Well, a couple of places. Well, the U.S. AI tech trade has shifted to the China AI tech trade. And that's a big reason why, the Hang Seng and the Hang Seng Tech Index has had this extraordinary move, because people are realizing that, the Chinese can create the same models we're creating here, and therefore commoditizing all these models. But, the China tech sector has been left for dead, and valuations got extraordinarily cheap. But I think that the China trade spreads out. It spreads out into other parts of their markets. We've been long and we've been suffering with, Macau casino stocks, to use that as an example. I do think one of the pressures on China, of course, has been the downturn in their real estate market, but we are multiple years into that. And I think we're getting closer to a bottom. You create that situation where you get a bottom in the housing market, well, then you're going to hopefully improve confidence with the Chinese consumer that has accumulated an extraordinary amount of savings. And that savings is not just going to be continued to be sit on. I think some of it's going to be spent, and hopefully for our sake at Macau casinos. But there's been a major China travel story that's taken place, mostly domestically, but it's going to grow internationally. And we're bullish on other parts of Asia as well: Singapore, Vietnam, Japan. Half the world lives in Asia. So I think investors are now beginning to look at those places. We are getting more excited about even Brazil, with Lula's polls in the toilet, which to me tells me that there is potentially next year, when they have their next election, there's going to be a shift to the right. If I'm right on commodities, which were long oil and gas, uranium, precious metals, platinum, fertilizers, that's going to be good for Brazil if that commodity trade can continue on. So we're getting long some Brazil stocks as well. And even in the U.S., I'm at my heart, I'm a stock picker, and I'm finding, cheap stuff in the small and mid cap space that that has been ignored by investors that only want the big names. And I think it's having also a lot less exposure to those big names. And there's also some, for investors, some very important questions that need to be asked. And even at the retail level, where we stand as a wealth management firm is, we've had such extraordinary gains in these big names, to the point where investors have major gains in them. Let's take Apple, for example. And, people have owned it for so many years, and they've done so well, and kudos to them, and kudos to, clients. But I think people have to ask themselves, can I still get the same level of returns going forward from here that is going to help drive my pot of savings? Or if there's like a major correction ahead, do I need to trim my holdings that may have gotten too big as a portion of my total portfolio? The answer we always get when we say to somebody, we think you should trim back on this is, oh, I don't want to pay the tax. Well, okay, well, can you handle a 50% decline in that stock? And if the answer is no, we always say, well, it's better to pay a tax on a gain than have no taxes because you've lost your gains. So I think just these are questions that people should ask themselves. We've seen since the history of markets, the leaders over a 10-year time frame tend not to be the leaders in the following subsequent 10-year time frame. And we need to wonder whether the next 10 years are going to be driven by other things, other parts of the market, and not the Mag 7 that have, again, done so extraordinarily well.
I've heard similar things from other guests too, of like getting back to like that stock pickers market and looking for value. One of the things is maybe it's like the Peter Lynch vintage, but one of the things like folks like Jim Bianco pointed out that maybe a lot of folks kind of forgot how to do that because it was just easy to buy the index or put your money in the Mag 7 or wherever. But now you have to get back to
one decision stocks, and it worked. I don't want to downplay it. I just think we're at a moment in time where maybe it's just not going to work as well.
Yeah, that too. And maybe people get too used to some of the stuff that's like, maybe that's not really how it's supposed to be. Right. Another question for you. I wrote this down. I thought it was really interesting. You were talking about the Mag 7 stocks, how pronounced they are, the foreign flows to these stocks, and it's creating issues with the US dollar. Could you elaborate a bit more? That was such an interesting point that I wrote it down. It piqued my interest.
Well, it was really just highlighting, the global attention that these stocks garnered, that the whole American exceptionalism thing. And, these companies got so big, it just drew in capital from all over the world. And you had people in Europe, you had people in Asia saying, why do I need to own local stocks when I can just own these US stocks that have just done so well? They're dominating the world. And I think it drew in, a lot of flows. And also we have to keep in mind, and it's very important, accounting reality. And it's not an opinion, it's math, which then ties into what the US, the new administration is trying to do with the US trade deficit, is that the US trade deficit being, at least on the good side, $100 billion a month. Well, the bigger the trade deficit you have, or the current account deficit you have, the larger the capital account surplus that you have. So as we send money overseas, because we're buying more stuff than we are selling overseas, those foreigners are taking their dollars and they've been reinvesting it back in the US, whether that's buying US treasuries, whether that's buying US real estate, whether that's buying any other US asset, including US stocks. So foreign ownership of US stocks, it became at a record high. And if you're going to buy US stocks with all your surplus US dollars that you accumulated because of our trade deficits, well, why don't you just buy the stocks that worked, that have the biggest market caps, that are the most liquid? So now if all of a sudden you start to see a reversal in this trend, and this money doesn't flow into the US to the same extent, well, that's negative for the dollar. If the US administration is successful in reducing the US trade deficit, that means you'll have smaller capital account surpluses that will not will have less flows reinvested into the US. That could be a negative for US stocks. So, and US assets, as this money either goes somewhere else or there's just less of it for them. Denominated in US dollars. So some mega trend potential reversals here that we're trying to figure out.
Again, this has been an incredible half hour with you. Can I sneak in like one or two more questions?
Of course,
or do you have to run? Okay. What does all of this say about where you see the direction of the US economy? Do you think we might be due for some like short-term pain, for some long-term gain? Like, how are you thinking about maybe the broader economy?
If government spending is going to get cut, or at least the rate of increase is going to slow, that's going to have a major negative drag on US growth over the next year or so. If this AI spend starts to slow, which on a quarterly basis there's some signs that maybe there is some hyperscaler slowing in AI CapEx. And if the stock market continues to have some shaky legs here, we are dramatically raising the risk of a recession. Because on the other hand, with the economy, U.S. manufacturing has been in a recession, and tariffs are going to just prolong this recession. The pace of existing home sales are at 30-year lows. Can this drop in mortgage rates maybe give it some life? Maybe. That's what we'll watch. But the affordability issue is still major. Lower to middle income spending is not going to improve anytime soon. From what I've heard on Q4 earnings calls and just this past week with some of the earnings calls I've listened to. So if you lose those three pillars with the lack of support in other parts of the economy, we're raising the risk of a recession for sure here, and that'll obviously flow into corporate profits, and so it's that's something that I'm worried about. Now, long term, while I'm anti-tariff, I'm very for DOGE and cutting government spending and reallocating capital to the private sector. Those are great big picture important things and getting some control of our deficits and debts. But there's no free lunch here. There's no clean handoff. There is pain to that paradise place.
That's a good way of putting it. Pain to get to the paradise. Peter, before I let you go, let's leave the folks with some parting thoughts. Anything that you would like to bring up in this discussion that you'd like folks to think about, please do that. And also let folks know where they can find you and support your work. Subscribe to the book report. Anything that you want to leave this audience with, the floor is all yours.
Well, just to sort of summarize what I said, I think that investors need to just start thinking differently. And, it's very easy to just assume that what has happened will just continue to happen and play on. I could be wrong in everything that I talked about and speculated on over the past half hour. But, from the things that I'm seeing, I do believe that there's some major changes taking place. And that's not to say that it's all bad. I think there are just new and different opportunities that are being created, but with a lot of risks associated with that. And I'll take one example. Let's take the U.S. defense sector, which has been a great outperformer because of the wars we've seen in the Middle East with Russia's invasion of Ukraine, with just geopolitical concerns with China and Taiwan. But look what's happening. You have Europe that is about to dramatically increase the pace of their defense spending. But you know what they're going to do? They're going to try their best to buy as much from other defense manufacturers in Europe, and even Canada defense sector is going to be a beneficiary of that spend, where to the point where they're going to want to buy less and less from U.S. defense manufacturers. U.S. defense manufacturers, which are some of the best in the world, may be losing some of our customers. So they're, again, big picture things here. China, we've made it an attempt here to try to deprive China of major technologies because we thought we would stunt their growth because we were worried about competing with them and we were worried about what they would do with it militarily. And I thought this from the beginning, that this was all going to backfire because what is the definition of innovation? It's necessity. And all we've done was light the fire under China's need to innovate themselves and become less reliant on us. So what's going to happen in the next 5 to 10 years? U.S. technology companies are going to lose a major customer in China. And not just that, we're going to have a major competitor in China and trying to sell our wares to other parts of the world. So another food for thought here.
Peter, again, so incredible having you back on the show. You're welcome anytime. You always get us thinking about new ideas. And wow, there's a lot for us to digest in this kind of new playbook, if you will. Peter Boockvar, Chief Investment Officer of Bleakley Financial, author of the book report. Thanks so much for being so generous with your time, all of your knowledge, your wisdom, and ideas. And great to see you as always, Peter.
Great to chat with you. And I so appreciate being on.